This LOS is compare the presentation and disclosure of defined contribution and defined benefit pension plans. So an introduction to pensions and other post-employment benefits. A defined contribution pension plan is one where the employer contributes a specified sum each period. There's no guarantee of future benefits, and the employee bears the investment risk. With a defined benefit plan, the employer promises a specific payment stream beginning at retirement. Contributions are based on years of service, compensation at or near retirement. The employer bears investment risk, and a separate legal entity is set up to manage the plan assets. So as the previous slide indicated, the two common types of pension plans are defined contribution plans and defined benefit plans. Under a defined contribution plan, a company contributes an agreed-upon defined amount into the plan. The agreed-upon amount is the pension expense. The amount the company contributes to the plan is treated as an operating cash outflow. The only impact on assets and liabilities is a decrease in cash, although if some portion of the agreed-upon amount has not been paid by fiscal year end, a liability would be recognized on the balance sheet. Because the amount of the contribution is defined and the company has no further obligation once the contribution has been made, accounting for a defined contribution plan is fairly straightforward. Accounting for a defined benefit plan is more complicated. Under a defined benefit plan, a company makes promises of future benefits to be paid to the employee during retirement. For an example, a company could promise an employee annual pension payments equal to 70% of his or her final salary at retirement until death. Estimating the eventual amount of the obligation arising from that promises requires the company to make many assumptions, such as the employee's expected salary at retirement and the number of years the employee is expected to live beyond retirement. The company estimates the future amounts to be paid and discounts the future estimated amounts to a present value using a rate reflective of a high-quality corporate bond yield to determine the pension obligation. The discount rate used to determine the pension obligation significantly affects the amount of the pension obligation. The pension obligation is allocated over the employee's employment as part of a pension expense. Most defined benefit pension plans are funded through a separate legal entity, typically a pension trust fund. A company makes payments into the pension fund, and retirees are paid from the fund. The payments that a company makes into the fund are invested until they are needed to pay the retirees. If the fair value of the fund's assets is higher than the present value of the estimated pension obligation, the plan has a surplus, and the company's balance sheet will reflect a net pension asset. Conversely, if the present value of the estimated pension obligation exceeds the fund assets, the plan has a deficit, and the company's balance sheet will reflect a net pension liability. Thus, a company reports either a net pension asset or a net pension liability. Each period, the change in the net pension asset or liability is recognized either in profit or loss or in other comprehensive income. Similar to other forms of employee compensation for a manufacturing company, the pension expense related to production employees is added to inventory and expensed through cost of sales, cost of goods sold. For employees not involved directly in the production process, the pension expense is included with salaries and other administrative expenses. Therefore, pension expense is not directly reported on the income statement. Rather, extensive disclosures are included in the notes to the financial statements. So here's just a summary chart, and actually this is from CFA Level 2, in fact, so it's really a nice to know, not so much a need to know, but it is a good summary. It's covered in Level 1 and Level 2. So we have the type of benefit. We can see the defined contribution pension plan, the defined benefit pension plan, and in Level 2 it steps up and talks about other post-employment benefits, such as healthcare, because retirees often receive healthcare. So then the first column, amount of post-employment benefit to the employee, the obligation of the sponsoring company, and the sponsoring company's pre-funding of its future obligations. So under a defined contribution plan, the amount of post-employment benefit is not defined. Actual future benefit will depend on the investment performance of the plan assets, and the investment risk is borne by the employee, okay? As opposed to the defined benefit pension plan, where the amount of future benefits is defined. It's based on a plan formula, often a function of length of service and the final year's compensation, and the investment risk is borne by the company. So we've seen that before, but this is just another nice little chart. And again, with regards to healthcare, the amount of future benefit depends on the plan specifications. The obligation of the sponsoring company, defined contribution, as we saw, the contribution, if any, is typically made on a periodic basis with no additional future obligation, so it's just a cash flow out, okay? But with regards to a defined benefit, the amount of the future obligation is based on the plan formula, and there's a lot of estimates in the current period. And with regards to pre-funding, defined contribution, not applicable. And with regards to defined benefit pension plan, companies typically pre-fund the defined benefit plans by contributing funds to a pension trust, and there's regulatory requirements to pre-fund. They vary by country. Okay, again, this is a CFA Level 2 slide, but it's a nice to have, not a need to have. But one of the things that I do in Level 1 is sometimes I give you a little bit of a preview to Level 2, because the goal is not only to pass Level 1, but also to get ourselves set up. So here we're looking at the components of a periodic benefit cost under IFRS. There's three components, which is the service cost, plus or minus the net interest income expense. Both of those show up on the income statement, okay? And remeasurements show up under the other comprehensive income. So service costs, plus or minus net interest income, plus or minus remeasurements, we call that the total periodic pension cost. So under IFRS, the periodic pension costs recognized in the PL include service costs, both current and past, and net interest income. So as I said in Level 2, some questions may not give you a past service cost. You only have a past service cost if there's been changes to the plan. Again, this is a bit of a nice to know, not a need to know. It's not too difficult to understand though, so I just thought I would include it. This is the components of the periodic benefit cost under US GAAP, so it's a little bit different. There's 5 items here that we need to be aware of. One is the service cost. We have the interest expense, minus the expected return on plan assets, so you can see that includes a big assumption, plus or minus amortization of actuarial gains and losses, and then we have plus or minus the amortization of past service costs, okay? And that gives you the total pension expense on the income statement. So a note here, under both IFRS and US GAAP, the assumed rate of increase in compensation, the expected annual increase in compensation over the employee service period, can have a significant impact on the defined benefit obligation. Another key assumption is the discount rate used to calculate the present value of the future benefits. So here's just a components of a company's defined benefit periodic pension costs, and it's a summary. So here we have the IFRS, and here we have the US GAAP. So as I mentioned, under IFRS, there's 3 items that we're looking at. The service costs includes past, recognized in the P&L. Then we have the net interest income or expense, also recognized in the P&L. Okay, and then we have remeasurements, net return on plan assets and actuarial gains and losses. And as I mentioned, that is recognized in the other comprehensive income. Okay, but under US GAAP, we had the 5 items. We had the current service cost, the past service cost, the interest, the expected return on the plan assets, and the actual gains and losses. And with regards to the US recognition, you can see where the current service costs are recognized in the P&L, past service costs are recognized in the other comprehensive income, subsequently amortized to the P&L. The interest expense is in the P&L. The expected return on plan assets is recognized in P&L as the following amount, the plan assets times the expected return. And again, the actuarial gains and losses recognized in the P&L, or more commonly recognized in other comprehensive and subsequently amortized. Again, this is a little bit of extra information for CFA Level 1, but it's 100% required for Level 2, so I just thought that I would give you a bit of a preview under this LOS. Now this LOS doesn't say calculate, but I did find an old practice question where it did ask you to calculate the pension expense, and that's why I just went through those previous slides. I just thought I'd throw this in so you can see here's some following information from a company, and they've got the employee costs, and then there's some notes to the financial statements. You've got the retirement benefit obligation, so I'm not going to run through all those numbers, and it's saying the pension expense in thousands reported in 2011 is closest to A, 1525, B, 2217, or C, 2253. Okay, so we can see it's giving you information, employee costs, wages and salaries, share-based payment costs, defined contribution pension plan, retirement benefit obligations, see note 17, which is below, other employee costs, and then we have the total employee costs. And the retirement benefit obligation is broken down to current service cost, interest on cost on pension obligation, expected return on plan assets, so we know this would be under US Gaap, this question, past service costs recognized in the year, and total income statement charge. So it's giving you a total income statement charge there. You can see that number 728 is the same as up here because it's asking you to go to note 17. Okay? Anyhow, I just thought I'd throw in this question. You can see the answer is really easy. The correct answer is C. The pension expense would be the sum of the expense for the defined contribution plan and the defined benefit plan. Okay? So here we just have it. It's just the two numbers, the 1525 plus the 728. So all this information was really red herring. So if you know where to zoom in, this question becomes very easy. If not, it can be fairly complicated. Now the LOS is not exactly calculate, but I thought I'd throw in these a few extra slides with regards to the calculation for the pension expense under both IFRS and US GAAP, because there's a entire reading on it in Level 2, so you might as well just get a little bit of a preview now. And that's the last slide for this LOS. Thank you.